Good morning. It's a Tuesday morning. You're watching Trading Hour. I am Reema Tendulkar. With me is Sonal Boothra in the red, but markets are trying to recover from the lows. Benchmark indices are down nearly 0.2%, 50 points lower on the Nifty right now, 24,725. Sensex down 115 points. Mid-caps continue to bear the brunt of the selling pressure this week. Today, it's down 1% for the week so far. It's lost more than 2.5%. So there's clear underperformance in the broader markets. But as we said, in the last 30 minutes, at least the fall seems to have been arrested. And now there is an attempt, a little bit of an attempt at a recovery. And banks, I think banks is where you are seeing a little bit of outperformance. ICICI Bank in particular is leading from the front. And IT, led by Infosys, is also a bit higher.
Yes, and some of these consumption names are also supporting the slight recovery that we're seeing in the Nifty. But of course, it's such a busy day, right? Today, Reema, we are talking about earnings reactions. We are talking about that big deal in the cement space. Of course, we'll throw some more light on that. We are talking about that big listing, the Hyundai listing, though it has been muted. But nevertheless, it is the big event of the day that we're tracking very closely. Right now, that stock is down 4%. And we do have a lot of stock-specific action in the broader markets as well. We have earnings reactions coming in on Jana SFB. That stock is down around 12%. Weak set of numbers there. Then we do have some of the earnings that we'll be discussing now. City Union Bank, for instance, is up around 13%. Good set of numbers. And that stock is higher by 13%. We'll be discussing that with the management as well. The outlook going forward. But for now, let's do one thing. Let's get some corporate conversations going. Aurionpro Solutions is under pressure today following its Q2 earnings. The company's margin has dipped both on a YOY and on a quarter-on-quarter basis. To discuss the company's guidance and the outlook post this quarter, we have with us Mr. Ashish Rai, the Vice Chairman and Director at the company, joining in now. Mr. Rai, good afternoon. Good morning. Thank you so much for joining in today. Can you give us a sense of what your guidance is? Do you maintain that guidance that you had given earlier of revenue growth of 30 to 35% and EBITDA margins of 20 to 22%? How will H2 pan out versus H1?
Yeah, thanks. First of all, thanks for having me. It was a good quarter. I think guidance, there is no change. So the business is trending quite strongly. So we feel we will grow north of 30% on revenue. We'll keep EBITDA between 20 and 22 and PAT between 15 and 16. The business is trending very, very well. I think there is strong demand environment is fairly strong. H2 typically is stronger for us than H1. Right, so we'll accelerate into the second half of the year and we'll deliver the guidance.
So revenue growth 30-35%, margins 20 to 22%, and profit margins 15 to 16%. In the current quarter, though, we did see your margins decline, Ashish. Can you explain what led to that?
Yeah, so the PAT actually is expanded. PAT is at 16% plus. EBITDA, there is a slight decline in margins, but I think I've said this before. At our rate of growth, we've been growing at 34-35% for 4 years now. At the pace at which we are growing, it's hard to calibrate down to the fine point. So EBITDA will stay between 20 and 22, but from one quarter to the next, it will go up and down a little bit. And there'll always some items. So this quarter, we had in one of the subsidiaries, we had a forex loss of 4 odd crores. So I think that probably shows up a point decline. But I would not read too much into EBITDA numbers sort of dropping from one quarter to the next. The pace at which we're building product out, the pace at which we're scaling up, we will always have EBITDA sort of varying from one quarter to the next, but we'll stay within the band.
All right. You know, you are looking at market expansion. Currently, India is around 61% of your total pie. You have APAC at 31%, US at 7%. Once this expansion does come into place, how will this pie change? What are some of the steps that you're taking for this expansion into newer geographies?
Yeah, so great question. Look, on the banking side, the business has been growing now at 50% plus, and we've seen a very, very strong traction in terms of Middle East and Southeast Asia. We announced a number of wins. We announced a win recently in Saudi Arabia. We've got a number of wins coming in MEA and Southeast Asia. On the transit side, Americas has strong momentum. We've, of course, US, I think we've done very well. We've expanded into Central America, Latin America as well. US, I think over the next probably 4 to 6 quarters should go into double digits as a percentage. Right now, you're right, it's 7 to 8%, but it's growing slightly faster than the enterprise growth. So I think we should get into double digits pretty quickly. We are now starting to build out our expansion into Europe. So slowly over the next 4 quarters, we'll see pipeline build up that well. So Middle East and Southeast Asia already growing very, very strongly. US growing strongly. Europe is the next focus.
So can you tell us the growth rates that you are seeing in these various geographies in India, US, Middle East, or APAC as you call it? Is it possible to give us the growth rate? 30 to 35% is, on a consolidated basis.
Yeah, so look, at enterprise level, we're growing at about 33, 34%. I think US is growing faster than 50%. The Southeast Asia and Middle East are probably growing faster than 50%. So I think on the banking side of the business, will probably, US would probably be even much faster than 50%, right? We'll probably grow the business 70, 80% this year. So overall, I think the international geographies are growing, but the India growth is also very, very strong. Especially the transit payments business in India growing strong, the data center business in India growing very strong. So I think it's hard to say how the mix will change. If India continues to grow as strong as the rest of the world, will probably stay more or less in the same region. But really, I think all parts of the geographies are growing quite strongly.
So if US is 70, 80%, Southeast Asia, Middle East is 50% plus, if your overall enterprise guidance is 30, 35%, what is dragging your growth down? Is it India, which is growing slower than 30, 35%?
Yeah, so remember the banking side of the business is growing at 50% plus, right? And that is roughly 55% of our top line, right? And that will continue to grow pretty strongly. We are recalibrating parts of the other segment, which is the technology innovation group, especially on the smart cities side, which was a bet in India, which we've slowed down a bit, right? So which is what would probably be a headwind on the overall growth number for some time, while we recalibrate that business for better economic profile and better margins, right? But even within TIG, transit payments will continue to grow strongly. Data center will continue to grow strongly. The smart cities and the government side is what we are recalibrating for margins, right? Banking will continue to grow at probably 50, 60%.
And the smart cities and government, the business which you're recalibrating, once again, just tell us those businesses and how much does it contribute to your top line?
So it's about a third of the TIG business, which itself is about 45%, right? So that's the slice which I've said before we've been recalibrating, right? And overall, I think the way we operate, the way to look at it is this: we are a IP-led products and platforms player, where one has to be careful as you scale up, right? Unlike a services project where revenue is a function of staffing the team, in a product business, there's a lot of interconnected parts. So we've been very careful in calibrating our growth. So various parts of the business from time to time, we will end up, giving them a pause to recalibrate for capacity, recalibrate for product build-outs. Banking, for example, last year and the year before, we had slowed down quite a bit because we wanted to focus the capacity on building out the products. So I think we feel our sweet spot of enterprise growth is somewhere between 30 and 35%. We do not want to scale the business so fast that we take on risks when it comes to deliveries, delivery reputation, all that stuff. In the product business, that's very, very important, right? So at various points in time, parts of the business will slow down, parts of the business will accelerate. So banking was slow last year and the year before. It's growing very fast this year, probably the next year, and we'll keep on pacing it. But at the enterprise level, I think one should expect 30% is where the sweet spot is.
Mr. Rai, quickly, if you can tell us if your acquisition Arya.ai, that one contributed this quarter, this had around 20 crore top line. How much did it contribute and what is the growth expected here?
Yeah, so I think the way to look at Arya.ai is a part of our bet on where enterprise AI is going, right? So there is obviously a lot of conversations around the frontier models and LLMs, etc., which have its own space. We believe as technology matures, a lot of value creation and hence a lot of value capture for vendors like us will happen on the application layer, which is where we're already very strong with the enterprise application stack we have. The goal with Arya.ai is to bring together a very mature enterprise application stack that we have together with a very mature ML capability, as well as new platforms that we're launching on Arya.ai side, right? So I think we've gone in terms of, we want to really lead the world when it comes to fundamentally AI native enterprise applications as they mature over a period of time. We've seen, like, I think the demand for the offerings together. So it's important not to look at Arya.ai by itself. It's important to look at that together with the enterprise application stack. I think the demand is really something we've not seen before, right? So most of the successes we had, for example, in Middle East, Saudi Arabia, etc., that we announced, these are transaction banking offerings going together with the AI enablement that we offered through the Arya acquisition, right? So more and more, every single Aurion Pro application, every single Aurion Pro capability will go into the market with a very mature AI capability, even AI native applications, right? So the demand is really very, very serious, and I think we're capitalizing on it.
All right. Thank you so much, Mr. Rai, for joining in today. So that's the word coming in from Aurion Pro Solutions. H2 is looking better than H1, and they maintain their FY25 guidance on the top line and margins as well. But to the big story now, consolidation continues in India's cement space with Adani Group-owned Ambuja Cements all set to buy 46.8% stake in Orient Cement. Nigel joins in with all the details. Nigel.
Well, that's right. Another deal, another big day. And that's the big one that the street was waiting for in terms of consolidation. And that was the deal that was announced earlier today. Ambuja Cements will acquire 47% stake in Orient Cement. Out of the 47%, close to 37% will be from the promoter entity, and the other people were the public shareholders out there. Because of the size of the transaction, well, it will trigger an open offer for another 26% in the company. What about valuations? Well, they're paying close to around 8,100 crores of equity valuations for a capacity of around 8.5 million tons. They say that this entire transaction will be funded by internal accruals. What does it work out to then? 8.5 million tons for 8.5 million tons, you're paying 8,100 crores. The rough EV per ton is around $114 per ton. Remember, Orient Cement as well is virtually debt-free. So both the entities, the buyer as well as the seller, both of them are debt-free. What all does Ambuja Cements get? Well, they've detailed it in their press release. They're saying their market share improves by 2%. The capacity as well moves up by close to 8.5 million tons. That's the operational capacity. Another 8.1 million tons is ready to execute, with regard to projects. So that's why they're terming it as around 16.6 million tons. But they're also saying they're getting a mine in Rajasthan. And with that, they can expand by another 6 million tons. Remember, with this asset, there will come the WHRS facility, the captive power plant as well, and the renewable capacity. Just take a look at the trajectory of Adani Cement, from the time they've acquired the unit. From 68 million tons, they have pocketed Sanghi, Penna, and now Orient Cement. And post this transaction, well, the capacity will go to around 97.5 million tons. By the end of this fiscal, it will go to around 100 million tons. What about the guidance they're giving in terms of ramping up this asset? They are saying that the Orient Cement asset can give EBITDA per ton of close to around 1,500 rupees per ton, with ROC of around 15%. Interesting to see how they get there, but they're talking about cost optimization and rationalization of realization as well. So to sum things up, it's a win, win, win. Why do I say that? For Ambuja Cements, they move towards the 140 million ton capacity. For Orient Cement, they get a better promoter. Remember, this promoter entity couldn't really scale up the volume, so the new promoter entity in all probability could do that. And consolidation from a longer term perspective is viewed as a positive for the industry. That said, Orient Cement is under pressure today because the stock had already moved close to 20% in anticipation of this deal, from around 300 rupees to 360 rupees. Back to you.
Thank you for explaining it so well. Need to get into a break. We'll come back and talk commodities. Manisha Gupta joins in on the other side.
Welcome back. It's time to talk about the commodity space. Manisha is joining in now, and today we are focusing on metals. Manisha, how are the moves looking there?
Well, positive really, because tangible commodities do tend to do well when you have uncertainty in the global markets, and the metal prices, which didn't do well in this previous quarter, this quarter actually seems to be picking up quite strongly. Well, you are looking at China economic data coming in on the stronger side for the month of September. It also has been a rate cut from China that has been supportive. So a couple of metals that I'm looking at, one is zinc, which is trading at around 2-week highs right now. There also is a report from international ZN Link, study group, which says that they're looking at a deficit in this year when it comes to zinc to the tune of 164,000. They also believe that the global demand can gain up by nearly 1.8% in this year, and that has been supportive. Smelters also are cutting production because of lower availability of concentrate, so all factors on positive there. The other commodity or the metal that you need to watch out for is aluminum. That one is trading at a 4-month highs. There has been strong China demand. Shanghai open interest for the current contract is at all-time highs, and then the aluminum stocks in China have declined by nearly 20% from its March highs. So all positives there yet again. Also, there is risk on bauxite supply that is coming in from Guinea. Indonesia government in 2023 had banned alumina exports, so markets have been dealing with that shortage when it comes to alumina. Also, when you look at the alumina prices itself, we have seen those trading at record highs in the previous week, still holding around those levels at this point in time. That is because when you look at the ratio as well, that seems to have increased. Earlier in the month of Jan, it was a 15% when alumina was priced at $350 a ton. Currently, in the previous week itself, we've seen that ratio go up to almost 25% because the alumina costing is now at around $633 a ton. So these are a couple of metals that traders are quite positive on right now because of the individual fundamentals there.
Thank you very much for that. Get into a short break. We'll come back with more on the market. Stay tuned. Now, as Hyundai India finally made its stock market debut, it's worth remembering that the South Korean auto major is no stranger to the Indian market, and it closes in on nearly 3 decades of operations here. Now, the car maker is all set for a new chapter. Bijut Sanid is now revisiting its journey over the last 3 decades. He visits the production base near Chennai and brings us the story of Hyundai and its romance with Tamil Nadu.
28 years ago, a little-known automaker from Seoul, South Korea, decided to open shop right here. Today, Hyundai may be India's #2 auto manufacturer, but if there's one constant in the South Korean auto major's 3-decade-long journey, it's simply the fact that it stayed true to its roots in India at its plant in Irangatukottai, near Chennai.
When I joined in 2001, it was 36,000 cars per year, but today we are at 765,000 cars. So the quality performance plays a very key and major role in establishing the volume growth.
As the cliche goes, Hyundai's Tamil Nadu plant has seen it all. From iconic launches like the Santro back in 1998, to the launch of the company's first ever compact sedan in the Accent back in 2014, to the start of its SUV era thanks to the launch of the Creta the very next year.
Creta launch. It was like a festival. So many, all the showrooms were bustling with customers, and like weekdays were like weekends. Customers used to wait in a long queue to experience the car.
In 2021, Hyundai celebrated a first right here where it all began. The company hit a production milestone of 10 million cars made in India, by which time it had already cemented its place as the country's second largest car maker. For Hyundai in India, the possibilities were endless.
You know, it was during the pandemic time that we launched the all-new i20 model, because almost we know that the entire nation, in fact the entire world operations have been stalled, and almost all our counterparts were shelving their new model launches and new model works. So But we also have had our options to postpone the model launch. But with Hyundai being the way we think, we like challenges and we would like to overcome it.
Hyundai's love affair with Chennai extends to well beyond the four walls of its plant. Only earlier this year, the company's flagship SUV product, the Hyundai Creta, became the automobile of choice to the Greater Chennai City Police, thereby strengthening the bond between the automaker and the city. Incidentally, Chennai is also home to Hyundai's hydrogen R&D ecosystem, where it has partnered with IIT Madras to invest 180 crore rupees towards developing a first-of-its-kind Hydrogen Valley Innovation Hub. Back at the plant, these production lines are all set for a brand new facelift, as Hyundai's recently released pre-feasibility report mentioned an investment of 5,000 crore rupees over the next few years towards modernizing these trusty old facilities. This means an increase in the production facility from 5.4 lakh square meters to 7.2 lakh square meters, thereby adding to its present-day headcount of 18,000. This expansion comes in the wake of Hyundai giving its legacy plant in Tamil Nadu a whole new look as it gets set for the next wave of EV launches. The company is confident the road ahead will be a lot more exciting as it incorporates and adapts to new technology, evolving customer tastes, and uber-competitive market dynamics. In Chennai, Jude Sanath.
Okay, facelift for Chennai plant, that's the Hyundai story. But for now, we'll slip into a short break. Sunil Chari from Rossari Biotech will join in to discuss their Q2 performance and more. Stay tuned. Welcome back. Well, let's talk about Rossari Biotech reported a steady set of Q2 numbers. Overall revenue rose 3% while operating margins came in flat at 13.2%. However, the textile specialty chemical segment is under pressure with revenue decline of 13% on a YOY basis. The company says export growth will outpace domestic growth going forward. To discuss more on this, we are joined by Sunil Chari, the Managing Director of the company. Mr. Chari, good morning. Thank you so much for joining in. I wanted to understand what's happening in the export markets. You talk about the fact that exports will outpace growth in versus domestic markets. How much exports are as a percentage of total revenues? They grew 32% in first half. What is the growth expectation in FY25? And are these freight cost issues causing any problems with exports right now?
Exports has been a focus area for growth, and especially in our HPPC segment. We feel exports will continue to grow, and our focus is on the US, the larger Americas, including North America and South America, and the Europe market. The focus segments besides home personal care is also agro and pharma and food processing. We see a very good demand and very good potential for growth in the coming quarters.
You say good growth. It was 32% in first half. Will you be able to replicate that in second half as well?
Our guidance has been 10% growth over last year. We do not know the geopolitical situation, so we would hold on to that guidance at this moment.
I thought the revenue guidance, sir, was 12 to 13%. So this 10% guidance is?
Yeah, the 12 to 13% is something which we would like to hold on to, yes.
Okay. But since exports is growing much faster, does it mean the domestic business is a bit subdued and you're also facing some capacity constraints which you're addressing?
We have capacity constraints also, but we also have constraint from ethylene oxide, which is our key raw material. We buy this from Reliance, and Reliance was to expand in April 2025, and they have delayed it, and that is one reason. But we still expect our non-ethylene oxide products, which are in R&D pipeline, to grow in the coming quarters.
Okay. So, you were talking about 12 to 13% growth that you'll see in exports, but domestic with ethylene oxide, there are some issues that you're facing. The other business that has been under pressure is the textiles chemicals business that has continued to be under pressure. What went wrong this time? Is a bigger export contribution coming in from here? And what is the outlook? Will it continue to be under pressure in the second half as well?
Yeah, Bangladesh, is a good market for us, but the geopolitical situation in Bangladesh, there was a change in government and things were a little slow, but I think they are falling back in line. India textile has also been subdued. But we hope the home personal care and performance chemicals and even animal health and nutrition should more than cover up for the slow growth in textile chemicals.
So in this home personal and performance chemicals, HPPC, which you call 60 to 70% of your overall revenues, you've said, the growth in exports has been higher also because you enjoy higher realizations and margins versus the domestic market. So can you tell us how much higher are the export margins versus domestic? And in the domestic market, are you seeing pricing pressure?
The FMCG, companies have been slower in the last quarter. As you all know, you cover all those companies. We see, I think, this Diwali season, we have good orders now. All our sites are doing well. The exports margin are generally 2 to 3% higher in gross margins than the domestic market. Even though our gross margins were higher, we had higher freight cost, and we continue to add a number of people in sales, especially services, and also R&D. These are two focus areas for us to grow. The new expansion, which is coming up also, needs a lot of people, which we are already taking now. This is something which we feel is investing for the future, and the future seems to be very bright.
So this in the domestic business, what was the volume growth in H1? And again, is there pricing pressure because FMCG sales have been slow?
Yeah, so this is something which is very heartening is the volumes have been in the range of 10% growth. And if you see our last 6 quarters, every quarter we are growing. At 498 crores, we are the highest ever quarterly sales. Our institutional chemicals business is doing very well. The Rossari Professional, which we call, which is a 100% subsidiary, we are growing by leaps and bounds. In the PAT and EBITDA, we are also, doing very well. And I think we have the highest EBITDA ever in our history. In terms of also, we are at Rossari, we are at this moment sitting on about 40 crores of cash, growing at such a good speed, investing, and still being like a zero debt company is something which we are proud of.
Okay. All right, Mr. Chari, thank you so much for joining in today and giving us all those details. So that's the word coming in from Rossari Biotech. Steady set, and they expect growth to continue going forward between 12 to 13%. Time for a short break. Management of City Union Bank joins us next to discuss their Q2 numbers and the way forward.
Welcome back. City Union Bank is fired up in trade after reporting the Q2 earnings. The bank's asset quality has improved. The net interest margins have came in, expanding to 3.67%. To talk more on the numbers and the way forward, we have with us N. Kamakodi, Managing Director at City Union Bank. Thank you very much, sir, for joining in. This is Rima here. So the first question is on loan growth. You've accelerated your loan growth to about 12% year on year and up 5% on a quarter-on-quarter basis. You've seen strong growth in the gold, NBFC segments, and plus in Q4, some of your retail products for home loans will also come out. So by the end of the year, what is your guidance on loan growth? And if you could give us the demand for the individual segments you operate in.
This question on what is our guidance, we have maintained that we will not give any specific guidance and all. But what we have told, particularly with the analyst in the yesterday con call, is that before the end of the year, we should be getting back to the industry level average growth. In fact, we had about 14% growth in the December 2022. For the December 2000 calendar year, there was some setback and we accelerated. We crossed double digit in the June quarter and we were able to firm that up with the 12% now. So going forward, we see definitely we will be able to get it back to the industry level growth rate. And this growth has basically come from our conventional, like say the sectors like MSME, gold loan, agriculture and all. And the new segment, whatever we wanted, like the retail loans and all, are yet to give their own contribution. And whatever growth we have achieved so far is purely from the traditional conventional sector where we were very strong in, and in the same sector only it is continuing. The other sectors, when they start contributing, the growth rate can further increase beyond this industry level growth rate is what we expect. And we are able to see the growth firming up with the existing MSME, secured MSME and gold and agriculture sector itself.
So, Mr. Kamakodi, when you say right now it's coming from the conventional sectors, the growth for your loan book, going forward, how much will the new segments contribute to overall loan book? And which will be those segments?
They are all basically secured retail segments from the affordable housing, loan against properties and things like that. And in over a period of 3 years, our expectation is that it should be about 6 to 7% of our expanded portfolio is our expectation. It will be happening in stages.
Okay. Do you want to put some more color on 6 to 7%? How much next year? You launch it only in Q4. So how much in FY26? How much do you go up in FY27?
See, basically, we have explained that in terms of the contribution to the P&L. So, like say, first year of like say starting the product will be like say there will be some amount of cost which we have taken upfront, and it will be breaking even in the second year, and the contribution to the profit will come from the third year. So basically, since we say in like say 3 to 4 years time frame to get 6 to 7, incrementally it should be about 2-3% additional contribution to the growth should be what we should be expecting in stages.
All right. You had earlier guided for net interest margins at around 3.6%, but now we are also in a cycle where we might be looking at rate cuts. In that case, do you maintain this guidance for NIMs going forward? And what about your asset quality as well? Where does it stand? Do you maintain the earlier guidance?
Yes, all the guidances which we gave in the earlier, like say, calls, and earlier quarters, they continue to hold. The net interest margin, like since the reducing interest rate cycle is probably expected to start little later, probably some advantage we are getting into. Whatever we said earlier that like say 3.6% plus or minus 10 basis point, whatever we communicated, they hold in net interest margin. And on the asset quality front also, we said we should be having about 800 crores slippage for the current year compared to 1,000 crores in the last year. All the guidances what we gave earlier, and we should be getting into the range of 1 to 1.25% in the net NPA for the current year, and all the guidances whatever we gave in the past, they continue to hold.
Okay, all right. I also wanted to understand on your advances, because they have improved 11.5% on a YOY basis, 4.7% on a sequential basis. This is also a number that the street seems to like. Can you give us a sense of what growth will come in here going forward, and which are the segments again which contributed to advances growth this time?
Yeah, as I explained to you earlier, whatever growth you have seen so far has purely come from our traditional segments like MSME, commercial trading, agriculture and gold loan. The same sector is expected to contribute, and we were growing, like say, below the industry level growth rate, and we are catching up, and we should be able to get the industry level growth rate before the end of the current year is what we have visibility, and what is that is the thing we have already communicated to the market.
Thank you, sir, for joining in. Have a good festive season. I wish you all the very best. Get into a break. We'll come back with more on the market. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Well, there's some more pressure that we're seeing on the markets right now. 140 points lower on the Nifty. The mid-cap index is taking further beating. So that one is down around 900 points. And Bank Nifty is the one which is leading to the losses that you are seeing. The index is down 360 points as we speak. And if we talk about the stocks which are leading to the fall that we are seeing from the top, something like an SBI, HDFC Bank, you have IndusInd Bank as well, which has led to the fall that we are seeing from the highs. There are also some of these consumption names, something like a Titan, you have Britannia. The other names are the likes of Asian Paints. So there are a lot of these heavyweights which are leading to the cuts that we are seeing on the Nifty from the highs of the day. With that, let's move on. Speaking at a Morningstar conference today, SEBI whole-time member Ashwini Bhatia raised concerns of the frenzy in the F&O space and said that F&O cannot be a national pastime. Listen into comments coming in from him.
India accounts for the largest volume of F&O globally. We are number one, and globally also, more than 50% of the F&O volume happens in India. This is a crown we do not wish to wear. F&O cannot be and should not be a national pastime, which actually means that savings of retail participants move into the pockets of institutional hands. So just look at the numbers we have told you. 3 years, 1,80,000 crores, and it has been losses for 93% of the investors. 1% make 99%. So your odds are terrible. But the surprising part from SEBI angle is this. The moment we came out with the latest regulation, which kick in sometime in November, investors are protesting that, lot size 5 से 15 क्यों कर दिया? Investors are protesting कि आपने सिर्फ एक ही expiry हफ्ते में क्यों कर दी? Investors are also protesting upfront क्यों कर रहे हो, margining and so on and so forth. But finally, this is becoming systemic. As I said, this F&O cannot be a national pastime. You need to do serious investing. We want India to be prosperous. Wealth is being created very, very fast. And I think investors should participate in the wealth creation that is happening in the country.
All right, that's the comment coming in from the SEBI member. But with that, we'll wrap up. As we do that, here's a small programming note. As we prepare to ring in the festivities this Diwali, tune into CNBC TV 18's Market Movers Forum 3 p.m. onwards on the 24th of October, featuring guests like Ramdev Agrawal, S. Naren, Nilesha, and others to help your portfolio prosper this Diwali.